Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Wednesday, May 1st, 2024. Today we of course had the FOMC rate decision and conference, and both of those events proved to be very uneventful. We saw a pop in the middle of the day in stocks going right back down to basically flat for the day. Notable data coming out today, ISM Manufacturing. This is a survey based on managers, what they're purchasing to make stuff basically, and whenever it's below 50%, it means that there's a contraction in this area. And so the last rating of this was just over 50. The expected was just under 50. Sorry about that. And the actual was actually lower than what was expected. We were expecting a little bit of a contraction, and the contraction was greater than we thought. And we see a similar movement in the job openings report, the last being 8.8 million job openings, expected 8.7, the actual 8.5. The cracks are coming in. It seems that the pressure the Fed is having on the market looks to me like it is doing a little bit more damage than what was expected, at least on these two reports for today. Later this week, Thursday, of course, tomorrow we have initial jobless claims and factory orders. Not the most interesting data, but Friday, the big number that I'm looking for is the U.S. unemployment rate. The expected is 3.8%. I've been tracking this as a chart and waiting to see, is this going to be heading lower again, or is this it? Is this when we're going to be trending higher and higher and we hit the big recession? Are we going straight into the recession or not? That's kind of what this number tells me. It's the biggest, most important thing that I see happening this week. The main headlines coming out today regarding Powell talking today is taking a hike off of the table completely, apparently, and still generally hawkish. He wasn't like overly hawkish or overly dovish, just kind of basically neutral, and the market basically took that as neutral to slightly dovish. We had a little bit of movement in the Fed funds futures. The probabilities swayed a little bit more towards a little earlier cuts, sort of, but nothing really moved all that much. Notably during the day, if you were following the market during the day at all today, when the FOMC meeting started at 2:30, it's amazing how the market just started to rip up and then go right back down to where it started. And one thing that's interesting about any report or anything that people are talking about, including like just for example, the Treasury refunding, that was in the news everywhere. Everyone was talking about it, and it turned into a nothing burger. Like nothing changed as far as market perception as to what's going on. Similar thing today. Nothing's really budging here. I mentioned the dollar breaking out of what looks like a bull flag here yesterday, and we broke right back into these two lines that I had drawn, and so I was expecting this to perhaps go higher from here, and it hasn't done that yet. I still think that this is going to break higher in the dollar going up in value, but we have yet to see that. HYT zooming in. This is high yield corporate bonds that smaller companies guarantee. They promise they're going to pay these high yields, and the yields go up and the value of this fund goes down when investors really smell or are sniffing out some higher risk going on. And so this is why I always like to keep track of this. I was surprised to see this close within the candle of this first red candle of what I was describing as three black crows here. This shows a lot more bullishness in markets than I expected. So I don't really know where things will go from here. Luckily, I'm not in this trade. I'm not in stocks in general right now. I just kind of am gauging this. I was expecting this though to roll over, not with enough conviction to be, shorting the whole stock market right now or anything crazy or any option plays. But yeah, this still was unexpected for me. So we'll see what happens from here. I'm thinking, looking into my crystal ball, on Friday, for example, those unemployment numbers, if that starts really shooting up, HYT is going to, I believe it's likely to react to that. 30-year Treasury bond yield, I mentioned yesterday seeing potential head and shoulders looking thing. Maybe this is where the neckline is, and then we could see this be the right shoulder there. But if I, for example, if I angle it like this, and we see that the shoulder, that the head, and this the right shoulder, and we breaking below it here, I've been saying I think that this is a top in yields on the long end of the curve, and I still believe that that's true. I see it in my crystal ball fairly clearly. It's a little smudgy, but I do believe in it. As mentioned yesterday, Bitcoin breaking down. Seems like it wants to keep going down from here. Gareth Soloway, the great seance of reading markets, has been predicting a target of somewhere between 52 and 54,000, I believe. So we'll see how that works out. He is one of the greatest seances out there in markets. And so I won't be surprised to see if we hit that area soon. CNN Fear and Greed Index. As long as we're in fear, I like to share this every day. When things are, usually the market's greedy, neutral to greedy. When things are getting a little fearful, that's when things are getting interesting, and things are fearful still, and things are a little interesting. Next, the VIX. This is the VIX. This shows the pricing basically of options contracts. Basically options contracts they're basically short-term contracts that gamble on short-term movements in the market, whether they're going to go way up or way down. So when the VIX is highly elevated, the market is expecting high moves up and high moves down, and so what happens is the premium, the price you have to pay for the contracts gets more expensive, even further away from the current price. And so that's how the VIX sort of works. I've been talking about now for a week and a half that it looks like, from this date that we've been headed towards this line. We almost hit it today. We actually, the bottom of this wick here, we actually got pretty close to it. I'll count that as hitting it, and maybe we're going to be heading up back here in the VIX from this point. We will see. I mentioned yesterday cannabis. I thought retailers, there might be enough dumb money out there to pour into cannabis right now, but instead it looks like there was a lot of profit taking. This could end up being a more bullish market. In fact, maybe I'm underestimating the power and the value of this whole market, and maybe we have institutional buyers here. I mean, when you see a move like this, it's hard to say what's going on. Certainly, one other point of this chart is that when we zoom out here, the retailer certainly feels a lot of pain. Anyone that wanted to invest in cannabis from the beginning of this fund opening up in September 2020 through the beginning of 2021 got hurt really badly. We went from a peak of about $55 a share in this fund of cannabis stocks all the way down to $4 or $5. And that pain is still going to exist, and who knows, that could be actually suppressing this market, and we might have a run up here. I'm staying away from this only because I don't trust the potential earnings of this industry. I really don't know. I have no idea how to price these companies, and so if we get back down to like ridiculously low range of like $5, and I only say it's ridiculously low based on the idea that from a height of $55 a share to $5 a share, that's a 90% drop. And for an entire index to drop that much is just, it's gone too far. I can understand 80%. Even the Great Depression, the whole market dropped, I believe, 80, 85%, 90% in a whole index. That's too far. So if we get down to that range again, I'll be interested. But right now, I just like to kind of use it as a gauge, and it's an interesting market to track and keep follow of. I don't bring up individual stocks very often, but I've always known CVS to be one of these big staple companies that it seems like everyone has in their portfolio as a strong dividend company, and it had dropped a significant value today, about 17% on, I believe, not so good earnings. And so I needed to take a look at the valuation, and yeah, I mean, it's looking cheap-ish. I'd be more interested, actually, believe it or not, about almost half of its current price, or at around $31, based on the gram valuation of averaging the past 10 years of earnings, and seeing what price it would be if it had a PE ratio of around 7. That's kind of like, and that would be very cheap and a really nice place to get in. This could be considered to be cheap now. Its PE ratio on its current earnings is actually only 8.7, which for such a beloved stock is surprisingly cheap. But based on the fact that I believe it can get much cheaper, I'm not interested in this directly myself at this point. That's all I have for you for today. I hope you enjoyed watching. Thank you for watching, and see you next time. Robschild.